At 4:37 p.m. on a cold Friday afternoon, something happened that most people didn't notice until it was already over. Employees at a regional bank were told to step away from their desks. Customers inside were quietly escorted out. By the time the sun went down, federal officials had taken control of the institution, and by Monday morning, the sign on the building had changed. To anyone driving past, it looked routine. The doors opened, ATMs worked. Depositors could still access their accounts. But behind that calm surface, a chain reaction had already begun. Moments like this rarely make dramatic headlines at first. They appear as small, technical announcements buried in financial news feeds. Yet history shows that the early stages of every banking crisis look exactly like this. Quiet, controlled, almost invisible. What matters isn't the size of the bank. What matters is what the failure reveals about the system around it. Because banks don't collapse in isolation. They collapse when pressures build silently for months or years until the structure can't hold anymore. And those pressures are building again. For most of the past year, the public narrative has been reassuring. Inflation was said to be stabilizing. The economy was described as resilient. Markets climbed, analysts spoke of soft landings, and the sense of urgency faded. But beneath the headlines, a different reality was taking shape. Interest rates remained elevated longer than many institutions expected. Loans issued during the era of cheap money began to mature. Borrowers who had refinanced at 3 or 4% suddenly faced rates twice as high. Projects that once looked profitable no longer made financial sense. And banks, especially smaller and mid-sized ones, were caught in the middle. Imagine running a business where your income is fixed, but your expenses keep rising. That's the position many banks found themselves in. The loans they issued years ago were locked in at low returns, but the interest they had to pay depositors kept climbing as savers demanded better yields. Margins compressed, balance sheets tightened, and the stress began to show. At first, it appeared manageable. Banks extended loans rather than recognizing losses. Borrowers were given more time. Payments were restructured. On paper, everything still looked stable. But time doesn't solve structural problems. It only delays them. Eventually, reality arrives. And when it does, it tends to arrive quickly. One of the most dangerous characteristics of the modern financial system is speed. In previous decades, a bank run meant lines forming outside branches, people waiting hours to withdraw cash. Today, money moves at the speed of a swipe. Deposits can vanish in hours without a single person stepping through a door. Confidence, more than capital, determines whether a bank survives. And confidence can disappear overnight. That's what regulators fear most. Not insolvency itself, but the moment the public begins to question stability. Because once that question takes hold, the outcome becomes unpredictable. This is why authorities move swiftly when warning signs appear. They don't wait for panic. They intervene early, often over a weekend, to prevent uncertainty from spreading. To the average depositor, the transition feels seamless. Accounts transfer, cards still function, life goes on. But investors, creditors, and industry insiders see something very different. They see confirmation that vulnerabilities remain in the system, that the stresses of the past few years haven't been resolved. They've simply been postponed. And postponement has a cost. Across the country, thousands of banks are navigating the same economic environment.